Today we'll cover a commodity sector that might be a huge opportunity and an overlooked opportunity. First, what do you think is the biggest commodity market, the most traded global commodity? We've covered gold and uranium to great extent, but it's not that. It's oil. There's Brent crude oil, and even WTI is hugely bigger than, for example, gold in average daily volume. But why did I say opportunity? I mean, oil price in futures was minus as late as in April 2020, and with oil now at 72 and 77 and clearly rejected here at resistance, how can oil and gas possibly be an opportunity? I have a very specific answer, but before we dive into that, I want to address ethics. Make no mistake, I think burning this much fossil fuels for energy is one of the biggest mistakes of humanity of my lifetime. It's going to be much harder for future generations to take those CO2 molecules out of the atmosphere and put the carbon back underground than it was for our generation to put that oil and gas on fire. As an engineer and as a father caring about the future even after I'm gone, I've covered the science and politics of the energy crisis to great extent in this video. So make no mistake, I'm not advocating to support the oil and gas industry to put more of it on fire for energy. But it's useful for other stuff. Fertilizer for agricultural use, for example, and we're not quite there yet with electric vehicles. Today, if you use an electric car and you use it a lot, it's definitely better for the environment. But if you buy an electric car and then only use it very seldom, that's today probably a bigger toll on the environment than a traditional fuel-driven car. The reason is that there's an upfront environmental cost to dig up and refine those battery metals. If you drive a lot, you might recoup that environmental penalty in 4 years, or some reports state even in 2 years. But if driving less, it takes longer. And for example, myself, I ride subway to work. I have a basic car with a big trunk that fits the stroller. We walk kids to school. I ride mostly by train if I go further within Sweden. So that car is parked the entire week, and I only use it some weekends to drive the family to some outing or something like that. And even then, we often take the subway. If I retire that car one day for a Tesla, I'd feel the joy to experiment with AI and so on, and I'd probably enjoy it. But it's probably not a good deal for the environment, even after a couple of years. In fact, that environmental equation might never recover. People like Elon Musk, of course, knows this, and that's why his vision is that there will instead be a fleet of Teslas driving around by themselves so that the battery gets utilized all the time. Then this equation will recover in a couple of months, and it's a massive environmental gain. We're just not quite there yet. The rest of this video will only approach this from an investment perspective, but I wanted to cover this first because it's important to me. I'm a huge supporter of replacing energy production with non-fossil alternatives, including nuclear power. I do not advocate burning up coal, oil and gas to make electricity. Alright, let's now zoom all the way out and look at both the global macro picture as well as what's happening to various oil companies. We are at the tail end of a super cycle in the bond market. As the bond market collapses, as we see here, and as you know, trends tend to continue, there could be a flight into safety of hard assets. The only way in which this is being managed currently is based on quantitative easing, the printing of money by governments. But this can only be a temporary delay of the inevitable. As you can see, this is basically on the path to zero. Moreover, we have seen in the UK last year that the gilt market was freezing up. The central bank said it would buy long-dated gilts on whatever scale is necessary to restore order in the market. If anyone doesn't know, gilts are UK government securities issued by His Majesty's Treasury. The UK gilt market is probably second after the US, the most trusted bond market in the world, and hence also one of the most liquid ones, which went no bid. This is beyond scary, especially if you realize that about 65% of all pension funds are invested in the gilt market. In addition, pension funds from the US, EU and so on are also invested there. And essentially nobody wanted to buy the bonds from the UK, so the Bank of England had to step in and buy them with money from quantitative easing. In other words, they were printing money to buy the government bonds, as there was no other interest. And in addition, for the pension funds, this means that as the interest goes up, the value of the bond goes down, and they are being margin called. Clearly, the Bank of England could not allow the pension funds to default. A similar situation we are currently seeing in Japan. Bank of Japan forced it to buy bonds in vast quantities, leaving it owning more than half the market. So Bank of Japan holds more than 50% of the Japanese government bonds. And just like with the Bank of England, this is a result of quantitative easing, basically money printing. So this situation, and in general the situation we see in many countries globally, is that governments are conducting QE or are about to. And this leads to massive inflation. Of course it does. If you print more money, you're going to have inflation. And it's basically everywhere. And some rather big countries have had like 100% inflation, and some even more. This inflation may be reduced currently a bit compared to last year in many countries. But the ongoing QE could also cause inflation to increase again later this year or in 2024. The point is, though, that the best performing asset in inflationary environments tend to be energy, gold, silver, real estate, and cash if used to take advantage of the volatility. And, of course, Bitcoin, the digital gold. Bitcoin doesn't have a long enough history during inflationary times, so that's a guess, but I think a reasonable one. Here we see a graph of US sector performance in high and rising inflation environments from 1973 to 2022. And there we see that the energy sector, which includes oil and gas companies, is one of the highest performing sectors. Such firms beat inflation 74% of the time, as we see on this axis, and delivered an annual real return of 12.9% per year on average. And as they write here, this is a fairly intuitive result. The revenues of energy stocks are naturally tied to energy prices, a key component of inflation indices. So by definition, they generally have performed well when inflation rises. Energy is underpinning almost everything, as we need energy to produce basically anything, including fertilizer. Today the price of oil is $72 for WTI crude oil, ticker US oil, and $77 for Brent crude oil, ticker UK oil, per BBL, which is one of these oil barrels, which has these horrible definitions. So WTI is extracted from fields in Texas, North Dakota, and Louisiana in the United States. Brent crude is extracted from the North Sea near Europe, oil fields including Brent, Ekofisk, Fortis, and Oseberg. They have slightly different composition. WTI is delivered in Oklahoma, a land dock area. Brent is extracted at sea, making it easier to transport. So oil quality, location, delivery logistics, and global supply and demand lead to differences in pricing. So for example, if worrying about closing one of the transport routes, that can lead to a premium of one versus the other. That can be substantial, and individual events can lead to big price action. Natural gas today, and I use this ticker, is trading at roughly $2.39. S&P 500 today is trading at 4,183. And now I'll show you something interesting. If you take oil price in proportion to S&P 500, we see that we're very near a historic low. And even if we only go back to say 2008, we see that that ratio was 500% higher, or 6.6 times. So if that ratio ever returns, UK oil would be at $500. Crazy? Perhaps, but let's explore it. And gas divided by S&P 500. And again, we don't need to go back to the 90s. Let's just look at this portion. In 2008, that ratio was 39 times higher, which would give a gas price of $93 instead of $2, taking it to all-time high. I'm not saying that will happen, I'm just pointing at possibilities to highlight that this could be an interesting sector to look at from an investment perspective. Okay, so we have oil and gas and uranium and gold, which are investments that have been a good hedge in inflationary times. But are there any other reasons to invest in oil and gas companies? Yeah, there is the oil and gas supply side aspect. The largest amount of supply has come from the shale space. All tier 1 assets have been explored and drilled as much as possible. There are more, but the cost of production is much higher, so you can see that this chart starts to flatten out here compared to the slope of previous years. And OPEC barely barely meets their production targets of already reduced quotas, the main reason being a lack of investment in infrastructure and capex spending. And add to that in the Western countries we have political agendas which reduce capex spending even more than the OPEC in these areas. Then you have all the government subsidies coming into the green energy space and renewables, intentionally penalizing fossil fuels through taxation and so on. That means that from an institutional investor perspective, there is not much interest to invest in shale or oil and gas currently, and that could make these assets undervalued now, if that pendulum swings back later. Finally, as we all know, there is a war going on in Ukraine. A war is inflationary and requires large amount of energy. And if we look at China, they have finally opened after their crazy zero COVID approach, and energy demands are spiking. The International Energy Agency raised its forecast for Chinese oil demand to 15.9 million barrels a day. Bottom line, this could add up to a constrained oil and gas market with production getting less funding while consumption is still happening, which could be an opportunity for a contrarian investor. Let's look at some charts. Oil has trended up since basically the beginning. And you can see very clearly this resistance area here. Imagine if we get a breakout here. But then there are some crazy charts in this space. Look at this ticker, BOIL, 25,002. It's like a rug pull meme coin. Imagine if this starts turning up. I don't fully understand the mechanics, but stuff like this gets me interested. UNG, United States Natural Gas Fund, 1,500. Exxon, old traditional companies. And as you can see, it has performed really well. Not only here, like back in the 80s, 90s and 2000s, but since the bottom here in the COVID dip, it has made a good 4x, and with growing dividends. MCF Energy buys assets in Europe for pennies on the dollar and starts producing gas. Could get interesting. And check the volatility of these companies. This is like crypto, 40x. And actually, before I started looking at this, I didn't expect that companies like Chevron had these strong charts actually. This has been some solid investment since before I was born. And it hasn't changed. Look here at the textbook breakout. This was a very clean entry if I had looked at this just earlier this year, just when LARSSON line flipped gold. BHP Group, long-living assets and good dividends. Multi-commodity, also active in coal. The largest demand for coal was in 2021 and then 2022. 2023 might be even higher. Again, solid chart. Could be worth monitoring for a breakout. PBR, not for the faint-hearted. My friend Mark, who you know, wrote like this, that it's cheap on a price-cash flow basis, does well at high petroleum prices, in effect an arm of the Brazilian state. With the left being voted in Brazil, more dividends may be paid, which is great for dividend searchers. But the difficulty is if you pay too much from your free cash flow, you hamper the ability to pay these dividends going forward. They have huge frontier resources, and $1.90 was apparently the last dividend amount paid on a share price of little over $10, so almost 20% dividend. And as you can see here, there is also a clear horizontal boundary in play. Trend turns up, breaks out this resistance, could definitely be interesting to monitor. Now, 3 very important things. Number 1, if you're not yet a member, remember that you get the commodities scope included with the course and LARSSON line indicator access. You're getting crypto and tech stock scope and commodities. If you're interested in commodities on ctolarsson.com, please use the commodities tab here. Scroll down, press get it here. That helps our tracking so we know how many are interested. And like today's Friday tier report with the expanded commodity section, I think it's spectacular. Number 2. If you are a member since earlier, there are now only 12 days left to secure the 50% discount on LARSSON Line Pro for life. This price will double on June 7th. And I will close it early if I can't handle the support load of new users who just joined. So if you want it, go to ctolarsson.com and press Pro. Number 3. You might have seen a theme here the past couple of days about energy. If you haven't seen the video on Bitcoin mining from an energy perspective and how that compares to what Bitcoin is replacing in the traditional finance, definitely watch the video I published yesterday. We got lots of comments like this. This is one of the best videos I've ever seen on BTC ever. Thank you, Grant. So please don't miss it. It's free and I think very insightful. Like and subscribe. Thank you, tack. CTO Larsson out. Hej då.